All right, guys, we are here today to kind of talk about one of the trading strategies that is very important in the financial markets for a lot of different traders and actually a lot of different institutions. So, this part of the course, if you're watching this on the course or if you're just generally watching this in general, is going to be a good detailed starting, point for you as far as learning another trading strategy that you can put in your tool belt. Okay. Um, those of you that are watching this on like the course and stuff like that, afterwards, once we go over the fundamentals of this, we're going to go into some deep dive details about actually how to go into doing this strategy, step by step. So let's go ahead and jump into it. A lot of times traders always asking, like how I'm able to dissect and find, some of my swing trade strategies and, how I'm able to get them to be on point and everything like that. A lot of my fundamentals will come from this trading strategy that we're going to review right here. Um, you know, so definitely pay attention to this. All right. All right. So what we're going to pretty much jump into here today is the method as far as what you hear a lot of times with banking strategies might use, or you might hear places say trade like the bankers, things like that. We're going to go into that strategy here. I'm going to break down how it works. I'm going to break down, what type of traders this is for, when it actually works. I'm going to break down things for you to look for and what to avoid when it comes to utilizing this strategy. And I'm also going to show you guys, just how to use it to your advantage and a little bit more when it comes to this trading strategy. Okay. All right. So what does that all mean? Well, basically, if you guys ever noticed that, there's situations where you're looking at a chart or a graph and there's a lot of volume, but there's not a lot of price movement. Or you ever heard people say, or advertisements that might say things like, oh, trade like the banks and, utilize the banking strategy, trade with the institutions and things like that. We're going to break down this method that they're talking about and charging you hundreds and thousands of dollars to actually learn how to do. So hopefully this video is a big value for a lot of you guys who always wonder, what are they talking about when they're saying how to trade like the bankers, trade like the banks and institutions, blah, blah, blah. This video will hopefully break down all that stuff for you. And of course, don't limit your learning to just this video, guys. I definitely encourage you to go look other, maybe other videos, read more books, stuff like that. Just if this method here interests you, okay? But hopefully this will just kind of get your foot in the door as far as getting you direction to, learning some more stuff and how to become a successful trader, because that's what I, really want for you guys. All right. So let's go ahead and jump into it. What are they talking about when they say trade like the bankers, and what is this banking strategy everyone is talking about? Surprise, surprise, guys, is basically the Wyckoff method. Okay, that's what they're talking about when they're talking about trading like the bankers. A lot of institutions utilize this trading strategy to, profit throughout the market. I'm going to break down exactly how they're doing this so that you can, utilize it on your own, like I said, or just, develop strategies, that might work with it, that'll benefit you and give you an edge. So the way the Wyckoff method, works is based on the Wyckoff cycle. All right. This right here is just a little, brief graph here that kind of breaks down how that overall works. You'll see here, that's the Wyckoff price cycle that we're going to talk about here. Basically, with the Wyckoff method, Richard Wyckoff, wrote about the financial markets like, early 20th century. At the time, like, where I think it was like Charles Dow, Dow Jones Industrial, Jesse Livermore, very popular trader, and other, analysts, figures who were very popular at the time. Excuse me. He was one of the, Richard Wyckoff was one of like the most pioneered, technical analysis, traders out there. And the Wyckoff method still works to like this day. It continues to be like a good guide for a lot of people who trade and invest. It's a really great way to pick, winning stocks and have a little bit of advantage, of times to buy, when to buy stocks, and, really one of the most effective risk management techniques that are out there. That's, another reason why I like that as well too. But the Wyckoff method and, the observations are really based on a lot of like price action, when it comes to utilizing this method. And you'll see a lot of the, key elements are going to be outlined, with like price trend development and, certain periods of the actual cycle, like the accumulation area, markup phase, in the markdown and the distribution phase, all those things. And we're going to break down each one of those sections and, phases so that you guys can kind of further be able to identify, pretty much this entire cycle and the different changes within like the broad spectrum of like the uptrends and the downtrends and the sideways markets. Okay. So let's kind of go ahead and get into that. Now, a little bit about this strategy. Again, very popular strategy, comes from teachings from, Richard Wyckoff. But to kind of simply put it, basically what you're going to do is fade the highs and buy the lows. That's really what you're doing there. Okay. Really one of the key things that you need in order to, be able to successfully utilize this is going to be, something, trading stocks that have like low volatility and a good trading range. The low volatility is going to help reduce the risk of being able to have the trade go against you sharply. And especially when you're first learning how to scalp, the trading ranges provide you just like a method of where, you can place like your entries and exits and stops, things like that. Also with this trading strategy, just want to add this in here, people that utilize this, there's a lot of different indicators in here. So this is why I don't really recommend this for people who are just like starting out. And that's why you guys are viewing this. Those of you who are viewing this in the advanced trading course, this is for, a little bit more of an advanced trader to be able to utilize, because you're already going to know some of these indicators and things that I talk about that's going to be able to work well with this trading strategy. Okay. Now let's talk about the phases of the Wyckoff cycle. All right. So phase one you have is the accumulation phase. Phase two, you're going to have the markup phase. Phase three, you're going to have the distribution phase. And phase four, you're going to have the markdown phase. As you're learning this stuff, guys, and you're kind of seeing it and actually implementing it, it's going to be very easy for you to identify. Okay. So let's just kind of talk about exactly what that is. So the Wyckoff accumulation phase is just when a new cycle begins of like accumulation that generates a trading range. The pattern often yields like a high failure point or a spring, off of a selling climax. That's where it's typically coming from. And usually that's the head of a strong trend, and then eventually, the exits and opposite sides of the range. So basically, the last decline that's happened is usually like algorithm driven. Is awfully observed after you're seeing the downtrend and the sell-off of a stock that's already ran up. Okay, and that's usually followed by the recovery wave, and that's when the price begins to start to act as support. Basically, you can kind of see that in this area right here. See, it came off the stock itself, and in this general illustration, the stock is coming off of a falling down off of a big run, and now it's starting to accumulate right here. This is the first part. The markup phase is usually followed by, areas of accumulation, and it breaks, a new trend, and you begin to see the price start to rise up and rise up. Okay. This is similar to like, buying dip patterns, which is, popular along many traders, but it's basically, after the reaccumulation phase, it begins to mark up everything, and then you start to see steeper pullbacks when it comes to these stocks. Okay. And basically it's like a correction phase. It'll continue to accumulate, but you'll see like different phases, and it'll generate like new highs coming throughout the markup phase. Now the distribution phase, this is where it begins to fail to break new highs. And you guys will see this a lot of times with like, like head and shoulders pattern, or just like general areas of resistance, different patterns that we already talked about in the, beginner's course. A lot of that will show like, a lot of areas of resistance. And this is the distribution phase because they're going ahead and selling those, shares that were accumulated, which is preventing the stock from being able to break out. When it fails to generate new highs in the distribution phase, it'll usually give you that little range there after a big run up. Okay. And that's just smart money taking profits. Again, they've accumulated it right here. It began to, continuously show levels of support and begin to mark up the price, and now they're starting to distribute those shares that they accumulated in the accumulation phase. Okay. And that's pretty much kind of how that works. And in turn, that kind of leaves like, weakness in the, the security in like the weak hands, and they're forced to kind of sell because of the range, and it's not really, playing out how they thought it would play out. And the new markdown phase will begin right here at this point. And that's the bearish period where, they generally start to throw in like different sections of resistance that's usually being established by short sellers too. So That's pretty much that phase. And the markdown phase, basically, the slope of the downtrend is going to begin to like start to happen, and you'll see that's usually redistribution, and it just basically attracts new positions that'll eventually get sold. Really much steeper bounces at this point, and usually the markdown ends once the base signals start to come off the accumulation phase, which is like right in this general area here. You can see that that's when it starts to end. Okay. And like I said, we're going to break down these little different sections here more while we're in, within this part of the learning exercise here. Okay. All right. So you guys know now what I teach you, and of course, what is pretty much, fundamental in trading, that every, method and trading strategy does have a set of rules that it follows in order for it to be successful in your odds. So the same thing it is with this here as well too, with the Wyckoff method. So this method is based off the Wyckoff cycle, of course, and of course the cycle itself has a set of rules, and these are the rules that you want to remember when it comes to utilizing the strategy. So go ahead and write this down, okay? So if you want to look up, Wyckoff's theories and strategies and all that good stuff later on, you can. But here's just kind of a summary of it. Once we go over the market cycle and phases, you'll be able to take a look at the rules and apply it to the actual, trading method based on the market cycle and phases that's there. Okay. So number one there, of course, is having an established trend. Okay. So established overall market's trend, is most likely to continue to further its direction. Assess whether supply and demand indicates that the market's position itself, in order to move up or move down. You want to identify that. Recognizing that trend is very, very important. Number two, select the stocks that follow the same trend. What is meant by that is you don't want to be, going against the trend, and you hear that a lot of times when it comes to trading. So if a stock is falling off, but the trend in that market that it's in is rising, you don't want to utilize that stock in that trade. Okay. Number three there is selecting the stocks that are under the accumulation phase. Okay. Now these are stocks that have the potential increase in price to meet or possibly exceed the price objective. And you usually see that in that accumulation phase when you're looking at stocks within that trend. Okay. Number four there is movement decision. So decide whether or not the stock is ready to move. Examine the price, the volume of the stock, and the behavior of the overall market that it's in. Be sure that the conclusion that you have is valid and that the stock is a good choice before you take in any type of position. Okay. So keep that in mind. As you're getting more experience in the market, you'll be able to identify that much more easier than before. Number five, of course, is look for rallies and runs. Okay, time your trade to be able to take advantage of the larger market turns. So in general, you want to buy stock that you selected to determine that the market is going to be able to reverse and rally. Sell a stock if your analysis indicates that the market is going to fail. Seems like it's common sense, but you'd be surprised how many traders end up becoming bag holders because they're afraid to admit that they were wrong or maybe made the wrong decision at that point. But keep that in mind. Look for runs and rallies. Utilizing those rules within the Wyckoff method and strategy is what's going to help you be successful with being able to utilize this. Okay, and you're going to see here in a second how that kind of breaks down. So within those Wyckoff rules there, you'll be able to identify different phases within that. Okay, and I'll kind of break those down for you here. But basically, it kind of comes off into two different things there. Rule number one, of course, is the market and the individual security. It'll never behave the same way twice. So keep that in mind. Rather, trends unfold through a broad array of similar price patterns that show, infinite variations in sizes, details, extensions, etc. Each incarnation changes just enough for, from the prior patterns, just to surprise and confuse, people that are in the market. Many modern traders might call this like shape shifting and things like that, to always try to stay one step ahead of the, the profit seeking that's done by the institutions who utilize the Wyckoff method. Rule number two there, the significance of the price movement typically is revealed itself once it's only, compared to price action from the past and how the behavior acted there. So basically, in other words, everything in the financial markets is contextual. And that means that is based on the way that you evaluated today's price action as compared to what happened yesterday, or last week or last month or last year. This rule is basically states that, analyzing just a single day's price action in a vacuum is going to typically end up giving you incorrect conclusions. So that's why when you hear me say, like, you always want to look left, that's why that's what you're analyzing. How was that price action, the last week or the week before, the month before, the last year? You got to look at all that stuff in an array of context when it comes to utilizing this trading method. Okay. And as we're getting deep into this, guys, you'll understand it some more. So let's analyze the different parts of the Wyckoff cycle. That way you'll be able to kind of see this in much more detail as I explain it and be able to break it down for you. Now that we know the different rules that are there, we're going to break down the different parts of the cycle. Because remember, there's 4 parts into the overall cycle. So we're going to break down and analyze each one of those different phases so that, you can know when they're applicable, and, knowing these different parts is going to help you strategize on how you might want to approach, trading any security that you're utilizing in this cycle, in this trading strategy. All right, so let's kind of break down the accumulation phase. This is probably going to be the easiest thing to kind of be able to identify. And again, I'm going to walk you guys through that. If you're watching this in the advanced course, afterwards, we're going to kind of walk through all this stuff here. So the accumulation phase, again, is essentially going to help you determine how far a stock can run. And, the more shares that are being accumulated, the further the possibility that stock may reach. Okay. Well, let me say that for you again. In the accumulation phase, the more shares that you're seeing being accumulated gives you an idea of how much, possibility there is for that stock to run up. Because the more shares that are being accumulated, the higher when you hit that markup period can happen is when more of those shares are going to start to be distributed. Okay. And when it comes to identifying that accumulation phase, first thing you're going to look for is the stock coming off of a downtrend. Okay. Price will begin to then move sideways after that downtrend. That's when you're in that accumulation phase. Okay. Again, I'm not going to get ahead of myself, but I'll show you guys how to be able to identify this stuff here in a second, real time. Now, let's break down that accumulation phase. Within that accumulation phase, there's a few different, sections of it. Okay. First one there, of course, is the preliminary support. You want to identify that. All right. Preliminary support levels, that's going to typically form after the market price has already fallen, as you can see there. And it just basically caused, big institutional players and smart money traders, they'll try to acquire bullish positions after a strong sell-off has happened. As you can see, that's happened here in the image there. A sharp fail happened. It bounced, and the price action began to just basically move sideways. That's an example of preliminary support. Once preliminary support is established, the market's going to find it, very hard to break that level of support just because of the fact that there was strong buying interest in that area. Okay, and you'll see here in a second how you can identify that here with the next section here. Okay. Number 2 is the selling climax, which is, in this area right here, and in this illustration here. The selling climax is another pattern in the accumulation phase that's, typically characterized by a sharp sell-off, and it takes place right before the preliminary support happened. All right. Obviously, you can't identify it until you see preliminary support, so that's why it's number 2. And that typically is going to indicate selling pressure has reached a stage of panic where, people who are absorbed, by the big institutions or smart money traders, begin to cash out and things like that. So with the selling climax is often, coincide with bad news or some kind of negative event that's happened, and, panic selling began to happen, and, investors just started cashing out and things like that. Big players, they'll usually use the selling climax to acquire positions at a lower price, and you can see in that image there that, examples of that happening right there. The bounce back in the market price followed after that action climax, reflects that buying interest from the big players. Pretty simple there. Boom, 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 boom. Number 3 there is the automatic rally. within that accumulation phase. The automatic rally, typically moves up and forms after the selling climax has happened. Okay. Um, the underlying buying interest pretty much just kind of caused the pricing of the stock there to rise a little bit higher, but prices will quickly fall back after making that new high. Um, and then the high interest points of the rally will just basically become an area of resistance within that range, and you can usually see examples of that in the image right here. So within that range there, that automatic rally, it just happens. Selling climax happened, buyers panic, dumped. Preliminary support came, big institutional players came and accumulated those shares at a great pricing point. And then, levels of support is being seen by other traders and other people who are interested in the stock. And then the automatic rally happens because the price is, just automatically happening from that, big level of support there. Number 4 there is a secondary test. You need that secondary test to make sure that this preliminary support level is actually a good support level. So you got to wait for that drawback to come back here when it comes to this. And again, I'm going to show you guys afterwards that are watching this in advanced course how you can be able to see this in a time frame. Right now here, what we're doing is just kind of analyzing the price action within the candlestick so you can know what to look for. But there's a little bit more things that you're going to need when it comes to that. Okay, but this secondary support test here is going to be the number 4 part of the accumulation phase that you want to know, so that you know that you're in the accumulation phase. Now, number 5 there is going to be springs. Now, springs are basically nothing but shakeouts. And it's getting rid of the weak hands. It typically happens in the accumulation phase. Prices will start to fall below the preliminary support. Okay, and that's just really to test the the waters there, and bring it back above the trading range in a short period of time. Often it's called like a fake breakdown. Springs are typically caused by big players just to mislead public and retail traders and things like that so they can get more shares at a lower price. Happens quite often. And this influences like people who are trading that are uninformed traders or investors who don't know any better, to basically get them to sell their shares at a lower price, and they expect the price to kind of fall even further because it's already came off of a already steep fall, and it hasn't breaking out within that range. So this is usually where the shakeout happens with the springs, and it's again usually within a short period of time. And you can see that, in this image right here. Now, after that, within that accumulation phase, you'll see number 6, which is basically the signs of strength. Now, the signs of strength will usually take place after that spring pattern has happened. And then, it's going to be able to indicate that bull market and strong sentiment is coming within that, that security there. Okay. So it has like a minor consolidation, small little pullback there. And then, just for confirmation of sellers who already lost momentum, and then the prices will continue to rise in the upside. And most of the time, those stocks will, break out, which is going to set up, often, a sharp rally to the upside. And you'll usually see that like in this image right here, SOS, signs of strength. So you got a small little pullback and then a sharp rally up. Okay. So, let me ask you guys this, to kind of get your gears going. I mean, what do you think? You recognize within this part of the cycle, something that you've seen before, may have learned from watching other YouTube videos, or either something better that I've shown in like the day trading course for beginners. These patterns are within this actual cycle. 1 through 3 there, simple bounce play. Okay, and you guys learned that from the beginners course. 4 and 5 is similar to from 4 to 5 here. This is similar to the sideways price action. Okay, and 5 and 6 is basically a normal trend there. I'm gonna let you go ahead and try to identify that. But if you break these sections up in the accumulation phase, these are trading opportunities within that actual phase there. Okay, so hopefully you learned that or kind of understand what I'm talking about when I say the trades within this actual cycle. All right. If you have any questions about it, let me know later. I'll tell you. But yeah, you'll see those trading patterns within this whole accumulation phase here. Pretty simple. Now let's go to the next phase, the markup phase. The markup phase is usually followed and measured by the slope of the uptrend. Okay, pullbacks to new support levels or offer buying opportunities that the Wyckoff method calls like throwbacks, which is similar to buying the dip, which is very popular amongst modern traders. You guys hear it all the time: buy the rip, or buy the dip, sell the rip. But the accumulation phase, it basically interrupts the markup with like a small consolidation pattern, and there's also like steeper pullbacks within the Wyckoff method that's called basically corrections. and you guys heard that all the time. Markup and accumulation will continue in these corrective phases, and they'll fail to generate like new highs. Okay, until the breakout. The markup phase is basically another stage in the Wyckoff method. Trading cycle that's basically preceded by the accumulation phase. Price action will move into like a long-term uptrend. This right here is all the markup phase. Okay. So you had the accumulation phase here, it's trading within the pattern. You got all that action happening that I broke down for you in the cycles, and then boom, here's the breakout, and then the jump. Pretty simple. Again, higher highs are happening within that time frame. Big players, completely already acquired their positions, and that just basically ends up creating like a significant buying power for the stock there. And traders who are, aware of this is going to jump on board with the trend and initiate that bullish position. The market phase is usually the most profitable stage to own the stock. Most of the growth and value vesting typically comes within that stage there, and it works out well during this phase. Okay, so pretty simple there. That's the second phase, markup phase. Now the distribution phase, this is where you're going to be identifying areas of resistance. Okay, pretty much just like the accumulation phase has its little, sections, same thing happens for the distribution phase, guys. So number one there, of course, is that preliminary resistance. Remember how like in the accumulation phase, it seemed like number two came before number one. Same thing here as it is with the distribution phase, with number one coming before number two. So that's why you got to always look left. All right. But the preliminary phase or the preliminary resistance is basically resistance levels that form after a significant price has happened or price, rise has happened within that security. And it's caused the institutional players, the smart monies, traders to start to acquire like bearish positions or you just liquidate their bullish positions, going ahead and taking their profit. Now imagine, that you notice that after a sharp rally of a stock going up, the price action failed and moved sideways. That's an example of preliminary resistance. And the market will, find it very hard to break preliminary resistance just because of the fact that there's strong selling interest there. And that's kind of like your first, area of resistance. Then you have the buying climax. So the buying climax is number two. And in that instance there, the distribution phase is usually, characterized by like a sharp rally that's happened. And it takes place right before the preliminary resistance. The buying pressure basically reached a stage where aggressive buying behavior in the public is offset by the big players. Buying climaxes often kind of coincide with good news, things like that, or something happened with public behavior. Big players often use that buying climax to offset any positions at the higher price. In this image here, you can kind of see how the examples of the buying climax pattern in the fallback into the market price by the buying climax basically reflects the interest of big sellers. So you can kind of see that right there in that area. Okay. Number three is the automatic sell-off, AS, right here. All right, so the automatic sell-off is basically the downward move that forms after the buying climax has happened. And that right there is basically the underlying selling interest that causes the price to fall a little bit lower. But quickly the prices will rise back and make it like a newer low, because the highest point of interest sell-off becomes typically when the support, the support basically distribution range. And you can typically see that in the AS, the automatic sell-off area. Okay. So after automatic sell-off has happened, buying activity from the public begins to decrease and the bullish sentiment becomes a little bit weaker. So when you're looking at things like maybe, level 2 or anything like that within that pricing range, that's when you want to start to see if big bulk orders or even, hidden orders are happening, throughout the actual price action of the stock. Okay. Number 4 is the secondary test, which is where pretty much the resistance is shown again. So the secondary test formation happens after the automatic sell-off has happened. And that's typically caused by like shorts covering and, public investors brings back the price into that area of resistance. Often prices will fall back after touching like a preliminary support or resistance. And then that'll indicate basically that presence of, selling interest happening. The secondary test is basically just a reflection of the market, and the prices basically have found a top at that point. And this is where a lot of traders don't want to exit trades and get caught up in that and begins to, fall. So much psychology happens at number 4 with the secondary test. It's ridiculous. We won't even go into that. That's going to be a whole nother section for this course. But yeah, basically it's just testing the waters there on the strength of sellers, and you can kind of see that image there with the number 4 there, the secondary test. Okay, the number 5 there, the up thrust, is basically nothing but just kind of shakeouts that happen within the distribution phase, and this price is basically just going to rise above the preliminary resistance a little bit, and then the trading range within a short period of time is going to be basically a false breakout. So it kind of suckered you in there, and then it pretty much brings the price back down. And you can kind of see that in that image as well too. It's basically like a confirmation of distribution phase and showing the signs of weakness. When you see that, that's letting you know, hey, things are getting weak in there. Either kind of cut your losses and move on, or if you're bullish, or vice versa if you're going to be shorting it. And then number 6 within the distribution phase is basically the sign of weakness, and that's when the up thrust pattern just kind of indicated the bearish sentiment there at that point and the sign of weakness. And then number 6, the sign of weakness, is going to break that preliminary automatic sell-off there. And basically it's like a buyer's confirmation that momentum is lost and it's time to kind of move on. And here comes the downside to this stock. Okay, so that's pretty much the distribution phase there, broken down for you. Pretty simple. Now the markdown phase, the last little bit here, the stage of the Wyckoff method, is again basically going to be happening after the distribution phase. It's just a long-term downtrend that you got to sit there and deal with. With the markdown phase, the slope of the downtrend measures, the down phase, and it's basically going to generate its own redistribution segments. The trend is going to pause for a while. The security is going to track new positions that is going to eventually get sold, and the Wyckoff calls this like a steeper bounce within the structures of corrections, kind of using the same terminology as like the uptrend, but the markdown basically it ends once the broad trading range or base signals that the start of a new accumulation phase. So this can happen almost indefinitely until you begin to see another accumulation phase happen. Okay, so unless you're like a short seller, if you are a short seller, you kind of have a little bit more time to be able to identify an accumulation phase, to be able to exit your position. But once you kind of get that signal after the distribution phase has happened that there's a breakout, it's a good point to enter into the trade if you're going to short sell it, because you're in that markdown phase and things are going to start to happen. But let's kind of break this down here a little bit with the markdown phase. So there's pretty much a little bit of different things to kind of look for within that. Really 3 key major patterns within there. The downside breakout, and you'll see that pretty much here. Basically, the big players or the smart money, they completely liquidated their positions. They're done. They've sold all their stocks from within the accumulation phase, and now it's time for this stock to kind of return back to normal. As a result, typically the price action will fall. It'll break the area of support in the distribution range, which was right here. This is going to attract the short sellers to start to come in, and that's going to, of course, begin to make the price itself go lower. That's the stage that most short sellers are typically looking for to enter in, and it's much more easy to identify if you're a short seller. Just of course, with short selling, you have unlimited loss potential. So kind of keep that in mind if you plan on doing that. But yeah, that's basically how it works. It's a major retest to the downside. The redistribution will give you some sideways price action there, and you can typically notice that the markup and the markdown phases, they're usually similar when it comes to like a traditional uptrend or traditional downtrend. The only difference is that the long-term trends that occur in the daily and weekly time frames. Okay, that's kind of like the main difference there. Pretty simple. So let's just kind of touch on this a little bit here as far as like the trading strategy itself for the Wyckoff method. A lot of times you guys have asked, well, what type of traders is this for? This is pretty much for traders who use ideal, swing trading techniques and things like that, because it's based off, the amount of time that it takes to complete the Wyckoff method. The time frames that can be used for this is ideally, the daily time frame. But you can use like weekly or monthly. It's used by many large cap stock traders too. So obviously, those of you who trade like larger cap stock markets, you know me, I'm a momentum trader and I trade small caps. So I don't utilize this strategy a lot, but I do utilize it for when I'm swing trading and things like that. And sometimes it can work on smaller cap stocks. The price of the stock depends, as well too, and especially ones that might be optionable. It might, it typically is a good method to try on those as well too. So like a stock can have a low price, but also, it can have a lot of shares out. So it's still something that it could work on because you have the ability to have like more stocks happening in the accumulation phase and the distribution phase because the market cap is so large, even though it's a smaller price stock. Okay. So that's pretty much who utilizes this trading strategy, guys. All right. So what to look for and the breakdown on how to successfully use this trading strategy. Now, when it comes to finding your entry points and exit points, when it comes to utilizing the Wyckoff method, you want to look for areas of accumulation by institutions, banks, LLCs, just large volume spikes with like little to no price movement, when it comes to that volume spike. Typically, an easy way to kind of look at stuff like that would usually be like insider buying on like, FinViz or any other scanners you might use, volume scanners to kind of be able to detect that movement. And then you're going to want to look at that chart. Now, once you kind of, done that part and, located, significant volume spikes in certain areas, you want to also look at upcoming news catalysts that could potentially propel the stock higher, and previous levels of volume spikes with no other movement as well, too. You can typically see that when plotting like areas of support and resistance. Um, that's when a lot of that stuff begins to unravel itself. And I'm going to walk you guys through that whole process here too, so you can kind of get an idea of, how to do that. Now, applying the Wyckoff method to your trading, in order to do that, you want to be able to familiarize yourself with the different 5 steps of the Wyckoff method. Is also the Wyckoff cycle as well too, because you need those rules within that strategy. You want to be able to track your target stocks, and look for areas of accumulation and distribution phases throughout that actual, charting there. You also want to place your trades when a stock price moves, from accumulation to a markup or distribution to markdown. Being able to make trades within those phases will definitely, help you out as a trader when you're applying the Wyckoff method cycle. So you'll know that, hey, in areas of accumulation, might be trending sideways. You want to look for sideways patterns in areas of actual markup. There's going to be a good trend of stocks going up, so obviously you don't want to short. You want to follow that trend. Areas of distribution coming upon the market or in the stock that you're trading in. Obviously, it's not going to break out. You want to get ready to set that expectation to go towards the downward side. And then the same thing as when the stock has already ran up and is going in the markdown phase. Time to be a short seller. So pretty simple there. In addition to that, you also want to place stop orders, on the opposite side of the trading range of what you're looking at, and keep tracking your stocks and your exit your trades when the price or volume or either both indicates that the phases are changing. A lot of indicators are out there to allow you to be able to see this stuff much more easily as a trader. We're going to go through all of those as well too, for those of you that are watching this in the actual course. Okay. All right, so just kind of recap everything as far as what we touched on. I hope this guys, helped you out and saved you some money from the spend money to go listen to some guru talk about, the secret strategy that banks use and all that good stuff to trade. But basically, we recapped the rules of the Wyckoff method, which is AKA the banking strategy. We talked about the different phases of the Wyckoff method. We talked about the different types of traders who might use this strategy. And we also just kind of talked about how to apply it as a trader by finding areas of, volume increases and not much price movement and different things to look at when it goes, to utilizing the Wyckoff method and applying it as a trader, and different ways you could trade different phases of the cycle. Okay. So just to kind of give you guys some final thoughts here. With the Wyckoff method, when I learned it, it definitely helped me to be able to identify different things and, to get out of bag holds and cut my losses and, take my chances and, rather than take my chances and continue to hold. That was kind of a big thing for me starting out as a trader, was being a bag holder, not knowing the fact that I was actually, in a certain part of the Wyckoff method where I should have just been cutting my losses, when that actually, was in different phases. It's not ideal for day trading to a certain extent, depending on what you're trading there. But ideally, the Wyckoff method and the banking strategy is good for people who can do long-term holds or swing trades. New traders who are in the market, I definitely encourage you to utilize this strategy to help you develop your patience and recognize your pattern recognition, because again, those patterns are also accumulating and forming in different phases of the Wyckoff method cycle. Okay. But for those of you who have issues with patience, using the Wyckoff strategy will help you practice that more and more as you become successful. Or those of you who are great with patience and don't have time to day trade and be stuck with stocks, for hours on end throughout the day, the Wyckoff method is a great, great strategy to be able to use because of so many advantages that it gives and risk to reward. This method works well in all financial markets, so it's good for all types of traders, whether you do crypto, whether you do Forex, whether you do options or indices or commodities, stocks, doesn't matter. Ideally, it is great for large accounts. Small accounts can do it, but it just takes more time for your account to grow, depending on, the results of the trade that you do. I know a lot of times you guys are wondering, well, how am I looking at, this chart on a, larger scale? You'll be able to do that when you're utilizing the Wyckoff method. You're going to use a larger time frame and want to take that stuff into consideration. So we went over all that strategy there for you guys, just to kind of give you some final thoughts on how I feel about the Wyckoff method. I think it's a great method. It's great for, swing trading. And again, the rest of you guys who are watching this course, we're going to do a little brief intermission here, and we're just going to jump into some real details here. I'm going to walk you guys through all this stuff here, give you some real-time examples, some real-time breakdowns, so you can see it from start to finish, what exactly is being, done with the Wyckoff method and how it's being applied, and what you need to look for as a trader. I'm going to walk you through a whole demonstration of that. Best of all, what I'm going to do is show you the tools too that you want to use to be able to successfully apply this method that might help you out as a trader and hopefully become more profitable. Okay. Other than that, these are just some of the sources that I kind of looked at, that'll help you, give you guys some more information. So feel free to snapshot that, take a picture or whatever, check out those links and get some more information about the Wyckoff method. For the rest of you guys who are viewing this, stay green, and the rest of you guys that are viewing this in the course, let's take a quick break and we're going to go ahead and get into some more stuff. Okay. All right, guys, stay green.
All right, guys, that wraps it up. Hopefully you enjoyed that video. If you did, do me a favor. Feel free to show some support for free by just hitting that little like button, comment below, following, and maybe even sharing the video with a friend, okay? We like helping people out as much as we can when it comes to trading. Take a look at some of the resources that might be available for you guys at the website. All the links and everything like that is below. Free tools for you to be able to help yourself become a better trader. If you have any questions, feel free to reach out anytime, whether it be DMs, if you're in the chat room, you want to shoot me a direct message, all that good stuff. Be more than happy to help you out as much as I can to become a better trader. Also, if you're new to the markets, you're interested in being able to do something like this and make the same money that we do kind of thing, you can also might want to consider taking a look at the courses. All the links to everything, resources are listed below. So feel free to join us, and until then, stay green.